There are a lot of methods to measure return on investment. Absolute, CAGR, XIRR, P2P, trailing, rolling. Confused about what to choose, how to apply? This video is for you. Hi and welcome to my channel. Watch this video fully and you will get a grip over these methods. Absolute returns. These are also known as total return. It is the calculation of simple gain or loss made in an investment. It's very easy to calculate. Final value minus initial value divided by initial value. This method doesn't consider the time factor. So this is suitable only for short-term investments. Next is CAGR, Compound Annual Growth Rate. This shows the average annual growth rate with steady compounding. The formula is ending value divided by beginning value to the whole power of 1 divided by number of years held minus 1. There is also an Excel function available here, that is RRI. This method actually considers a time factor, but only the starting and the ending date. So this is suitable only for lump sum investments. This method actually smoothens the fluctuations in return. So it is easy to compare investments over different period of length. Next is XIRR, External Internal Rate of Return. This is a new concept. This is just an Excel function. This shows the annualized return considering all the cash flows. This considers the time factor, irregular dates, uneven cash flows, and being an Excel function, it's easy to calculate. XIRR gives a true rate, the real growth rate. So use this XIRR function in your spreadsheet. Point-to-point returns. It's the simple return measured between two specific dates, very similar to absolute returns. So the formula is final value minus initial value divided by initial value. Next is trailing returns. This provides the annualized rate of return from a fixed start date till today. The formula is current value divided by starting value to the whole power of 1 divided by the period minus 1. Next is rolling returns. It's the annualized average return of an investment calculated across multiple time periods, including overlapping periods. This is generally used to measure the consistency of funds performance. To calculate 3-year rolling return on a monthly basis, the first set of calculation will be the returns from January 23 to January 26, and next set of measure would be February 23, February 26, and then March, and so on. With different returns calculated, a range is formed. To calculate further, you can take simple average of returns. It's easy to use multiple rolling return calculators available online. So, which should be used to measure your returns? Absolute returns. They are used for short-term, less than 1 year. CAGR for lump sum investments, long-term. XIRR for SIPs, top-ups, staged investments or redemptions. P2P returns. It measures from point to point, so generally short-term. Trailing returns measures point to point, but generally from a start date to today. It can be used for both short and long term. Rolling returns, this is generally checked for a long term, check the consistency and the best in worst past performance by the firm. So there's a quick summary sheet. Go through it. Take a spreadsheet and start tracking of all your investments and use XIRR. Happy investing, and don't forget to like, comment, subscribe to this channel. Thank you.